Okay, good evening and welcome to FSMOne webinar. And our topic today is strategies to invest in a volatile market. My name is Mark. I'm a client investment specialist from FSMOne Johor Bharu office. First of all, I would like to thank all the participants who registered and joined this Monday evening webinar. So we have invited our FSMOne Research Manager to present on this topic. We hope this will be benefits you. During the webinar, feel free to drop your question in a Q&A tab to let our speaker address the questions that you may have. With that, allow me to introduce our speaker, Jason Wong, FSMOne Research Manager. Jason graduated from the Australian National University with a double degree in Actuarial Studies and Commerce, majoring in Accounting and Finance. He is also CFA Chartered Holder. He has almost 10 years of experience in various finance and investment related roles. Currently, he is responsible for overseeing the Malaysian research team, which is cover Malaysia, Thailand, and Indonesia markets and investment products mainly in Malaysia. Without further ado, let's welcome Jason. Jason, the floor is yours.
Good evening, everyone. Thanks for joining us in this wonderful Monday evening. So as Mark has mentioned, today I'll be sharing some strategies to invest in a volatile market. These are some simple but useful and also very powerful strategies which you can use in terms of your portfolio allocation, your asset allocation during this kind of market volatility. Without further ado, let's move on. So for every investor, I believe when you start investing, this is your ideal way of reaching your investment goals, which is a straight line. But in reality, investing, it comes with ups and downs. So market, you see this kind of up and down movement all the time. This is what we know as market volatility. Market volatility could be caused by many factors. It could be due to geopolitics. For example, like what's happening in Russia and Ukraine right now. It could be due to the pandemic, like what happened in 2020 when stock market crashed because of the COVID crisis. It could be also due to some movements or in terms of the changes in terms of government regulation, like what happened last year when the Chinese regulators came in to introduce new regulations for all these tech companies in China. Other things like inflation or monetary policy can also cause market to see some jitters as investors or markets or analysts start to reprice their positions or their holdings based on the new information. This kind of market volatility may be something that can unnerve many investors, but hopefully in this session, I'll share with you some strategies which can help you, especially in recent times. If you are worried about the market volatility and if you cannot sleep well at night, we might have some few strategies which could help you. So without further ado, we move on to strategy number 1, invest within your risk tolerance. So this is very important as the first step because everyone, when you invest, you have a different tolerance for risk. Some people are okay with taking higher risk. Some people are okay with taking like medium level risk. Some people are not okay to take any risk at all. So it's important to know what is your risk tolerance level before you invest. So for example, if you are currently overly worried during this market volatility, you could be investing above your risk tolerance level, something that you're comfortable with. So for example, let's say the market dropped 5%, you're not comfortable with it. Perhaps it's time to reassess your risk appetite or your risk tolerance level. So typically, like for example, in this case, the moderate investor is okay with this kind of market volatility. Conservative investors would not be comfortable with that kind of moderate level of volatility. Then they will need to readjust their portfolios a bit later on. Okay, for aggressive investors, if they're okay with higher types of volatility, then it's fine for them as well. So in terms of how do you know where your risk appetite or your risk tolerance level is, we actually have a tool to help you. Okay, so if you're overly worried about market movements, you can actually log into our website, and there we have a risk profiler where you answer some questions such as your age, your investment horizon, reactions to certain scenarios in terms of market, and the risk profile will estimate your risk profile. And from here on, maybe you should make some judgment whether your current portfolio is aligned with your risk profile. Okay, because this is important. If let's say you're investing above your risk tolerance level or your risk appetite, okay, because you become uncomfortable during market volatility, you may be forced to sell some of the holdings at a losing position, which is not very recommended, okay, not very advisable. If let's say you're holding something within your comfort level, you're okay with this kind of volatility. In fact, when there's a market downturn, you have the opportunity to move some of your more stable holdings like fixed income and take advantage of the beaten down markets or sectors. So if you hold something within your risk profile, you have more leeway or more leverage to do this kind of thing, adjustments. In general, there are 5 types of risk profiles. Okay, conservative, moderately conservative, balanced, moderately aggressive, and also aggressive. So we have a sort of like a benchmark, okay, for each type of risk profile. For example, conservative investors, our recommended asset allocation is 90% fixed income and 10% equities. For moderately conservative investors, you move slightly up the risk profile category. The recommended allocation is 70% fixed income and 30% equities. And next step will be balanced investors, 50% and fixed income and 50% equities. And moderately aggressive investors, 30% fixed income, 70% equities. And lastly, aggressive investors, 10% fixed income and 90% equities. So once you have reassessed your risk profile, okay, then perhaps you relook into your current portfolio asset allocation. In our holdings page, when you log in to view your holdings, you can actually see what is your asset allocation. And from there, you can make some judgments whether this portfolio is within your risk tolerance level or not. And if you need to, you can adjust. I move on to strategy number 2, okay, to invest in a diversified portfolio. I think this has been mentioned many times before, and it is a viable strategy that has worked for many, many years already. So a lot of investors, famous investors, also have their own quotes in like telling people why they should diversify. I think the most common one that you have heard would be, don't put all your eggs in one basket, because if that basket drops on the floor, then all your eggs will be gone. Okay, so you need to diversify, put into different baskets. Okay, this is like an analogy for investments as well. You put investments in different type of investment assets just to diversify. In this picture here, we have Sir John Templeton. So this guy is famous. He founded this Franklin Templeton Asset Management Group, and his famous quote in his book, 16 Rules for Investment Success. His quote is, diversify. In stocks and bonds, as in much else, there's safety in numbers. So even famous people like him also say this kind of thing, because yeah, it works. So diversification is a risk management technique that mixes a variety of assets within a portfolio. This benefit of diversification will only hold if the securities in the portfolio are not perfectly correlated, which I'll explain more later. So this as well is just to illustrate that no asset class or no market is top every year, which is why if you invest in a diversified portfolio, you would have done pretty well over the long run. Okay, you have a bit of everything, you would have done quite okay over the long run. Okay, the positive markets or the positive assets will cover the shortfalls from the negative assets. Okay, so take some time to go through to look through this. So you see the color, the color shifts around all the time. Okay, red color is basically like your sectors. Green colors are your core assets like US equity, Europe equity, Japan equity, and the yellow color will be like your bonds. So the color moves around quite a bit, which is to illustrate that yeah, there's no evergreen asset class that outperforms every single year. 2021 was a good example. if you look at this chart over here, it's basically showing the diverging performances of markets across the world. And you have top performers like US, Taiwan, India, and so on. And at the bottom, you have like underperformers like Brazil, Malaysia, and China. But if you had a diversified portfolio consisting of a lot of these, like even an average of this, you would have done pretty well in 2021 as well, despite the perceived market volatility that happened in 2021. So just in the first slide for this strategy tool, I also mentioned that you have to diversify between using assets that have low correlation between one another. So here I've used a correlation matrix that I calculated to illustrate this. So how do you read this is that, firstly, I simplified it. I used just 5 major asset classes for typical Malaysian investors: global equities, Asian equities, ASEAN equities, Malaysia equities, and also Malaysia bonds. So these 5 asset classes. And how do you interpret this is that if you see the box, okay, if let's say this, for example, this box 0.7, okay, is the correlation between global and Asian equities, 0.7, and likewise. And if you want a shortcut, you just look at the most bottom here, the average. So what I'm trying to illustrate here is that the different markets, global, Asia, ASEAN, they are less than perfectly correlated to one another. Okay, that means if one market moves, the other may not move in the same magnitude or the same direction at any given time. And the lower the number, the better. The higher this number, that means the higher the correlation, which is not beneficial in terms of diversification. So what we want is something that is lower and closer to 0. So in this example, the lowest one will be Malaysia bonds, which is quite obvious because bonds is a different asset class compared to equities. So naturally, the correlation between these two is lower. And another one, perhaps something else to note, Malaysia equities also have quite a lower correlation compared to other markets. Okay, so this is important to remember is that when we build a portfolio, we try to combine assets that are less than perfectly correlated. The lower the correlation, the better, because it will add to the diversification benefits. So using the five assets, okay, I've built a simple portfolio to illustrate this. I've built a diversified portfolio, okay, 1, 2, 3, 4, 5, the assets, and 50% in Malaysia bonds, and the rest are equally weighted in the other equities. Overall, I've built a balanced portfolio, 50-50 between equities and bonds. And to me, this is quite a stable portfolio already, okay, and less volatile. And in order to illustrate this, I've calculated these 2 charts over here. The first chart on the top is the monthly ups and downs of this portfolio in the past 10 years, okay, how much it had gone up, how much it went down on a monthly basis. And you can see it's relatively in between this band. The worst performing month was during the COVID pandemic, when this balanced portfolio fell 8.1%, which is actually not too bad if you compare to a lot of equity markets, because like if you recall, S&P 500 was dropping like 8% or 10% in one day at the time. So yeah, for balanced portfolio, drop 8.1% in 1 month is still quite okay. And over the long run, you can see other than that, at most it dropped like 3.1%, 2.6% in any given month. So that's like the second worst or third worst month over the past 10 years since 2012. Okay. In addition, in terms of win rate, that means how many times out of the past, okay, 120 months, okay, because every year we have 12 months times 10 years, we have 120 months. Out of these 120 months, this portfolio saw 67% win rate. 67% of the months was positive, and 33% it was in negative territory. But overall, 67% is quite a decent win rate, if you ask me. The second chart to illustrate how stable this portfolio is the drawdowns during past market events. So the 50-50 portfolio that I showed you just now, I put this during some of the market drawdowns. For example, China circuit breaker in end 2015, early 2016, when the S&P 500 dropped 6.2%. Okay, the portfolio dropped 2.5% only. Okay, the US-China trade war in 2018 September, towards the end of the year, S&P 500 dropped 18% compared to the portfolio, which only dropped 3.8%. US-China trade war again, okay, second round in July 2019 to October 2019, S&P 500 dropped 3.8%, the portfolio dropped 1.7% only. And more recently, COVID crisis in 2020, S&P 500 dropped as much as 29%, whereas the portfolio relatively, okay, dropped 13.9%. And most recently, which is like 1 week plus ago, okay, Russia-Ukraine tensions, the S&P 500 dropped 7.8%, and this balanced portfolio, which I showed you just now, only dropped 1%. So this is just to illustrate that if you invest in a diversified portfolio using assets that are less than perfectly correlated with one another, you have this kind of diversification benefits, which actually help to maintain or lower down the overall portfolio volatility and also drawdowns during all these market events. Okay, so hopefully that's clear for you. I move on to strategy number 3. Okay, so the first strategy is to invest within your risk tolerance level, and then you start to build your portfolio within a diversified sort of assets together. And the third one is know what you own and know why you own it. So do the proper research and due diligence before you invest in anything, because this will help you reduce your panic during market volatility. So this was said by Peter Lynch. So this guy, some of you may know him, is a famous investor or famous fund manager from the US. So he was famous for managing this Magellan fund at Fidelity from 1977 to 1990. And he was famous because his average annual return was 29.2%. And this was consistently above the S&P 500. He consistently outperformed the S&P 500 and was the best performing fund in the world. So he grew the assets from 18 million to 14 billion, and it was closed. So only existing investors could have invested in the fund at the time. So he said this because, obviously you need to know what you own, and I believe it's very true, because especially during market volatility, okay, if you don't know what you own, then you'll be more panicked. Okay, I don't know what the company does, I don't know what the business do, how is it affected by whatever happening in the market, then you most likely panic and may be forced to sell the holdings without knowing what's going on. So it's better to know what you own and why you own it before you invest. So for example, like what's happening right now, Russia and Ukraine geopolitical tensions, right, is causing jitters in the market. So the big question is it fundamental or is it sentiment driven? Okay, so I think I don't need to go through what's going on over there, what's going on, but I would like to explain what's the impact to other economies, other markets, and also assets. So we did some research. Okay, if let's say all these sanctions on Russia is going on, what's gonna happen to other major economies? Because that will ultimately lead to, let's say, businesses being affected, economies being affected, this kind of thing. So we did some research and we looked at the major markets like US, Europe, Japan, and China to see what were their exposure to Russia. And our conclusion is the exposure is relatively limited, and we think that the impact will be quite limited as well. The spillover effects from this will be quite small, and mostly will be maybe European economies, whereas US and Asian will have very, very limited impact from this. So just to illustrate this, we looked at the trade between US and Russia. Currently, the trade between US and Russia, okay, Russia is about 1% of US total export and 0.7% of total import for the US. So it's very, very little, and most of it is commodity related materials. So if the US puts sanctions on Russia, okay, for some of these commodities, yeah, they just need to buy from someone else, and it's only 1% of their total imports. They can easily probably buy from Australia or Brazil, this kind of thing. So they'll just need to readjust in this way. The impact to the US, we think, is very small, okay, in terms of the economy. For Europe, similarly, Russia makes about 1.5% of EU's total export value and 2% of import. And most of these trade, mostly Europe, they buy oil and gas, energy from Russia. Around 40% of natural gas comes from Russia. Okay. At the moment, Germany, they have not sanctioned Russian energy. Okay, they haven't sanctioned it. I think at the meantime, they still need Russia. They still depend on Russia for their energy supplies, but they would need to start to look for alternatives already. Similarly, probably they need to look for the US, for example, because US, as you all know, they are a major shale gas producer, and probably that's where they can find the alternative sources for energy. Other than that, maybe they need to relook into their renewable energy policies as well. Okay. So for Europe, similarly, it's slightly higher compared to the US in terms of the trade, but it's still relatively small. Japan, no need to say, not a major trading partner. For China, they made up about 2% of China's exports and 3% of China's import, mainly oil and gas again, energy related one. So China currently imports about 30 billion of oil from Russia. This is likely to continue. Okay, they have a 30-year deal. And in 2014, similarly, we also saw this happen, this Ukraine and Russia tension happen, where Russia took over, they annexed Crimea, but China continued to support Russia in terms of buying all this oil and gas supply from Russia. So ultimately, what I'm trying to say is, we think that spillover effect in terms of the economy, okay, is little. Okay, most likely the US will probably source from other places, Europe will source from other places. So the whole world will still continue, except for Russia themselves. The economy in Russia will suffer. But fortunately, a lot of funds that we have very little exposure to Russia. Okay, the emerging market ones would have slightly more, but still relatively small part of the portfolios. And most likely, the fund managers would start to reduce some of these holdings in Russia. So Russia is the one who will suffer, but the rest of the world should be okay, if you think of it this way, like how I analyzed. So what is the impact of this Russia-Ukraine tensions on other, let's say, companies, corporates? So here I've used a household name in Malaysia just to illustrate this point of public bank. So whatever is happening in Russia or Ukraine, it has little to no impact on public bank, correct? Because they do mainly their business in Malaysia. So if, let's say, public bank shares drop, okay, but actually the fundamentals is still solid, right? Because they have no impact to whatever's happening in Russia. There's no NPL from Russia. Then they continue to generate revenue, continue to generate profits, and pay out dividends. So actually, it's a good opportunity for investors, long-term investors, value investors, to pick up a good company like public bank, right? If let's say they drop, I just use this example, but you can apply it across other markets as well. So how do I see all this fundamental info? So basically, public bank is just an example. But if you want to look at overall market, you can use our tools. Other than reading financial reports on our web, on all those company websites, all our articles, there's also this market indices tool on our website under funds, research market indices. Then you click market valuation and earnings here. And here you can access those fundamental info such as PE ratio and also earnings growth to see like, these markets are like continuing to grow their earnings. The corporates in this market are continuing to grow their earnings, which indicates that still growth, positive growth, rather than you see negative drawdown, this kind of thing. And also the PE ratio to show that these markets are not too expensive, and you can see like which markets are relatively cheaper compared to others, this kind of thing. So this is readily available on our website for our DIY investors. So another few charts to illustrate that we think that this market sell down is more, the recent one is more sentiment driven. We use past historical evidence. Okay, historically we have had plenty of wars. Okay, and here we have handpicked a few. For example, the Gulf War and Afghanistan War in 1991 and 2001 respectively. Likewise, the markets retraced. Okay, as you see, armies start to move into all these countries, but subsequently, markets rebounded very strongly. Not just rebound, it's like rebounded very strongly. Yeah, because ultimately, whatever happening in Afghanistan or Gulf, like the Middle East, the rest of the world still need to continue living on, right? Yeah, so ultimately they rebounded very strongly. Okay, and they became non-events. Basically, it's like nothing happened. Other examples: Iraq War 2003, market also retraced because after military preparation in Iraq, but after that, slowly recovered, rebounded. Then the more recent one, which is very related to the current Russia-Ukraine, is the Crimean annexation. Similarly, market retraced, but after that they rebounded. So yeah, ultimately we still think that the current drawdown in markets is mainly sentiment driven, and the spillover effect to the rest of the world is quite limited. It will mostly affect Russia the most. Russia will suffer quite a bit, if you follow, their currency has crumbled and their stock market has crumbled as well. So here are more examples, okay, of market correction events, not only geopolitical wars, but other correction events. On average, they drop about 16%. Then 1 year after the lows, they rebound about 10% on average, and 2 years, 23% on average, looking at the S&P 500. And if we were to pick out some geopolitical tensions in the past, here are some other examples, like World Trade Center bomb incident, 9/11 terrorist attack. So there were initial market retracements, market drawdown, but subsequently they do recover over the long run. Yeah, so for us, I'm sure a lot of you may be wondering what's our view on this. Is that we think that Western countries will continue to sanction Russia, okay, to put pressure on them to stop. And these tensions, the only way to stop this is really just for both sides to sit together and then discuss and then try to work out a plan. Like what happened in 2014. At this moment, if we look at fundamentals, we still think that it's okay. Okay, fundamentally it's still okay. Everything is still ongoing, with or without this war is the same. Okay, so we still think that investors should not be too panicked about this situation right now. Okay, I talked quite a bit about that. I move on to strategy number 4, dollar cost averaging. I'm sure a lot of people may have heard of this already, but did you know that if an investment is down 50%, it needs to rebound by 100% to break even? Okay, so in this example, let's say the investment started with $1. Okay, then this asset or this stock dropped until 0.5, which is a 50% drop. So from 0.5, you need to go back to $1. Is 100%, right? It's double up, correct? Now the second example here, if it drops 60%, okay, it needs to go up 150% to break even, and not 120% like a lot of people may think. Okay, so $1 drop until 40 cents is 60% drop, but from 40 cents to go back to $1 is 150% rebound. Okay, so I'm using this to illustrate the power of dollar cost averaging. To recover your losses faster, you need to do dollar cost averaging. This is a simple strategy that involves investing in the same fund or asset at different intervals. So by doing this, you can bring down the average investment cost and speed up the recovery process. So the same example, $1 drop until 50 cents, but you average down. Let's say you initially invested 1,000 ringgit. Then when it's at 50 cents, you invested another 1,000 ringgit, you average down the price, okay? And the break-even price becomes 0.665. It needs to rebound only 33% for you to break even compared to 100% before, okay? And similarly, the second example, if it drops 60%, $1 to 40 cents, okay? And you average down here, the required price to break even is 0.5716, which is a 42.6% rebound compared to 150% rebound initially. So it's a much faster recovery if you average down. Just to illustrate whether it works or not, okay, just now was just an illustration, right? Maybe you think that, that it's not going to work, this kind of thing, but let's look at a real example. Using MSCI Asia x Japan, okay, which has seen its fair ups and downs over the years, as you can see through this chart here. So let's back test this using past market downturns to illustrate. For example, in example number 1, global financial crisis in 08-09. So let's say you bought this MSCI Asia x Japan at the peak before it crashed. During the global financial crisis, you invested 100K at this index level, okay? By October 2008, you'll be down 47.5%, okay? If you do not average down, if you do not do dollar cost, you will need to wait until October 2010 to break even, which is like 2.5 years almost. But if you average down here, okay, you initially you invest 100K, then you average another 100K. Okay, the break-even point is 404, around there, which you can achieve in May 2009. Okay, much faster compared to waiting until 2010 October. Second example, European debt crisis in 2011. 2012 period, okay? If for those who were not born at the time, at that time, a lot of European countries in the EU fell into debt crisis. Okay, sorry, their bond yield spiked. Okay, and there were fears that they couldn't repay their bonds. Okay, so that caused the markets to jitter at the time. So if, let's say, you invested, let's say, at the peak before the crash in August 2011, you invested 100K. In September 2011, you'll be losing 25%. If you didn't average down, you need to wait until January 2013 to break even. Okay, but if you had averaged down, the break even is January 2012, which is like only a couple of months. So European debt crisis, take China hard landing and also circuit breaker. Yeah, so this is when the Chinese economy slowed down in time, and at the start of 2016, the Chinese stocks crashed, and the government introduced circuit breakers to so-called stop the rot, but it made it worse. It caused more panic selling. So Chinese stocks dropped quite a bit at the time. 2015 May it started. Let's say you invested at a peak, okay? You would have lost about 37.5 by January 2016. If you didn't break even, you didn't dollar cost, the break even would be 2017 May, almost 1.5 years later. But if you break it, if you dollar cost at the time, the break even is like 6 months later only. If you see this here. Last one will be the US-China trade war. Similarly, if you bought at a peak here, you would have lost about 21.5% in October 2018. If you don't break even, you need to wait until August 2020, like 2 years, almost 2 years later. But if you had averaged down, then the break even would have been relatively fast, like 6 months or so. So hopefully this illustrates that DCA, dollar cost averaging, does help you recover the losses faster and break even faster. Now, next question you might ask is how much to DCA, how much to dollar cost? Of course, if your dollar costs a higher amount, it will result in a faster recovery. But ultimately, it also depends on your comfort level. Okay, at the same time, managing the concentration risk of this asset in terms of overall portfolio. You don't want to over concentrate in terms of overall portfolio as well, and also of course your budget lah. So here, this table is the simple illustration is that no matter how much you DCA, it does help. Basically, just to illustrate that even though you DCA just 50% of the initial investment, it does help. And the deeper the drop, the more helpful the DCA is. Okay. The last strategy, number 5, that I have here, regular savings plan. So this is also a type of DCA. Some people or some investors may be quite emotional when they invest, like they look at markets and they can't really decide when to go in or when to DCA, because they might be afraid that it may continue to drop, this kind of thing. So regular savings plan is a strategy, or you can call it facility, to help investors invest a small fixed amount of money into the investment on a regular basis. For example, let's say monthly basis. So monthly basis, okay, the system will help you to invest a fixed amount into the asset that you choose or the fund that you choose. And this will help to smooth out the entry points. You invest sometimes in the low, and let's say it drops, then you just continue to average down when the market drops, and you benefit when the market rebounds as well. By doing this, you avoid trying to time the market, and also you remove all the emotional stress when you invest. So, like I said, some people may be very emotional. They don't dare to go in markets. They don't dare to dollar cost average. Then they might miss out on the market recovery later on. So this could be a strategy that is useful for those investors who are under that category. FSMOne, we do have this facility, RSP, we call it in short, regular savings plan. And here you just log in, you go under transactions and funds. You can choose what funds you want to do RSP, and you can choose the frequency as well, weekly, bi-weekly, or monthly, based on your liking. Then that's basically just it. Then it'll just auto invest the funds for you. So to wrap things up, 5 simple strategies to help you invest in a volatile market. Number 1, invest within your risk tolerance level. So this is very important once again, because if you're investing above your risk tolerance level, you could be overly worried when markets drop, and you could be forced to sell down or cut loss at a losing position, which is not recommended. Whereas if you're investing within your comfort level, you can sleep well at night every night, and there's even opportunity to take advantage of the market drawdown and redeploy some of your more stable fixed income or cash into those beaten down markets. Take the opportunity. Number 2, invest in diversified portfolio. So as I've illustrated just now, if you invest in diversified portfolio, you won't be too afraid of any market drawdowns, because you know that you're holding a solid portfolio that can weather through market volatility. And the statistics that I shared to you just now is proof of that. You can have a lower drawdown compared to whatever you see daily in, let's say you look at CNBC or Bloomberg, the market drawdowns. Okay, your portfolio, if you have a diversified portfolio within different asset classes, different markets, different currencies as well, different sectors, definitely, it will still be quite solid or stable during this kind of market volatility. Number 3, know what you own and why you own it. So this is also very important, because if you are not familiar with what you invested in, and the market volatility or the market comes in, then you could panic and you could force to sell at a losing position. Whereas if you understand the companies or you understand the market, that it will still do okay after this. It's just a temporary sentiment-driven sell down. You'll be less panicked. And strategy number 4 would be dollar cost averaging, is to help, it's a proven strategy to help investors recover losses faster, okay? And regular savings plan number 5 is just one type of dollar cost averaging where we do have this kind of facility for our investors. So I think that brings me to the end of my presentation. I'll take some questions right now. In the chat, I see a few. So the first question is it safe to invest to invest in bonds when interest rates will rise soon this year? Okay, so I think there's a lot of things that one of the big questions that a lot of people are asking, because in conventional thinking, bonds and interest rate, they have negative correlation, or there's an inverse relationship. When interest rate goes up, it will affect bonds, and likewise. So in a rising interest rate environment, I would say bonds is still a relevant part of a lot of investors' portfolio. Okay, but how you want to position your bond portfolio is the key, I would say. And we do have articles that explain this, if you can take a look at that. At this moment, okay, in terms of global bonds, we're actually asking investors to reduce the duration. Okay, that means the bond duration, you buy short duration global bonds. You buy those bonds with short maturities, because these bonds will have less sensitivity to interest rate movement. And yeah, they are less volatile during interest rate rising environment. So what I say only for global bonds is that, as you all know, the Federal Reserve has been going on this quantitative easing and bond buying, bond purchasing program for quite a number of years already. And this has pushed the yields for global, especially US yields, down to record lows. So when they push it down unnaturally, if let's say they remove this this bond purchasing, we call it tapering. Okay, they remove this quantitative easing, they remove this bond purchasing program. Okay, naturally it will start rising again on the bond yields, and interest rates, when they move up, the bond yields typically also follow. So US ones are still at record low, and this would, the what we've seen in the past, probably like half year plus, okay, is basically a reversal of that already, and global bonds were hit up. So if you had a short duration portfolio, it's not too bad. It's not too bad. And for Malaysia bonds, okay, is a bit different. So why I say that is that similarly, Bank Negara has cut interest rates to record low, right? 1.75% OPR rate. And the MGS yields, which is the benchmark used to price bonds, also went down. So they went down to a low during the COVID pandemic, but slowly started to come back up, the yields. And in fact, the yields went up much faster than what's happening in global yields. So the yields for Malaysia bonds are already back to pre-pandemic levels. In fact, it's even higher than pre-pandemic levels before Bank Negara cut interest rate. So I think in terms of the entry point for Malaysia bonds is quite attractive, much more attractive compared to global bonds. And if you compare the Malaysia bond yields compared to the peak, okay, it's not too far away. Whereas for US bond yields compared to their peak, it's still quite far away. And another thing probably to note is that we don't think Bank Negara will raise interest rates as aggressively as the US, because inflation in the US is overheating. It's like 40-year highs, the highest since 1980s. Malaysia, yes, there's inflation, but it's still relatively, the word that Bank Negara uses, modest, they use it. Yes, there's inflation, but it's not as serious as what's happening globally. So I think one of the reason is that our economy is not as strong as the US. Okay, so the demand side of inflation is not so strong. Okay, quite weak lah. And second point is that we have a cap on our oil price, petrol price. So that has helped to keep inflation within a certain level. Whereas outside of Malaysia, there's no subsidy on oil price. Okay, so it's basically whatever the oil market is trading right now, then you see how much the oil price they need to pay. That's what causing a lot of inflation in all these US or developed countries or even Singapore. So because of that, inflation in Malaysia is not as bad as the US, and Bank Negara does not have to raise as aggressively as the US. So I think these 2 points make me still like Malaysia bonds. Okay, is if you are a more conservative one, maybe you go for shorter duration Malaysia bonds. But if you are okay with a bit of volatility, actually, if you look at the Malaysia bonds since I think October or something, end October last year until now, it has been quite stable, which is in line with my view. So if you're a bit more aggressive, you can go like medium duration Malaysia bonds, like those 5 years range, okay, which has some the yield pickup is there, but you take on a bit more interest rate volatility, but the yield pickup can help you cover this interest rate volatility. Okay, second question. In the event Russia and Ukraine go into full-blown war, how much more will market correct? I think this question very hard for me to predict. It has a lot of markets were actually in bear territory already, like for example Nasdaq dropped 20%, but ultimately if you look at the last 2 days of the last week, they rebounded very strongly already. I think from the lowest 10%, they opened at around 1300, then it rebounded about total 10% from there already. So yeah, the market correct, but if we look at how the Nasdaq reacted, it seems like there are investors who see opportunity picking up good, strong companies at cheaper prices, and these companies are not going to be affected by what's going to happen in Russia and Ukraine. So how much more it will correct? This one, to be honest, I don't have crystal ball, but as I mentioned just now, if you know the fundamentals of the company and the market gives you a good price to go in, I think you can take the opportunity. Then if you only had 100 ringgit to invest each month, would it be best to invest in a fund that has bigger loss or the fund that has fallen off your target allocation the most? Okay, if you had 100 ringgit to invest each month, either you invest it in the fund that has biggest loss or the fund that has fallen your target allocation the most. This question, still trying to gauge the question. I think maybe I'll come back to this later. Okay, sorry. What if after average down the market dropped further? Okay, good question. What if buy another better performing fund instead? Oh, okay. I think if you average down and the market drop further, I think one analogy I like to use is that you look at the market now. Okay, is this price reasonable? Is this a reasonable price to go in? If you think it's yes, then why not? Will it drop further? I don't know. But at this price that you're paying right now, is it reasonable to go in? Then if it's yes, why not? If it drops further, it gets cheaper for and the fundamentals don't change much, then perhaps it's another time to average down. But typically, I think if a few percentage drop, I wouldn't really average down because it's very easy to recover back a few percentage drop. But 10-20% maybe can start to DCA. So if it does drop down again, and I think that the price that to enter is still very cheap or even cheaper or reasonable, I'll average down again. What if buy another performing fund instead? Okay, so if the performing fund, is relative speaking. So if this fund is performing, let's say performing very well, but there's no upside potential already. It has outrun the positivity. It may not continue to rally lah. So ultimately need to look at what's the upside potential of this performing fund before you buy it lor. Then I think that answers that question already. The world stocks market seems to be bearish across all asset class. So how to diversify our stocks or UT portfolio? I had quite diversified unit trust, but now down by 6%. Okay. I think if we look back, let's see, I have another thing. Yeah, okay. So I think this year, at the start of the year, Asian and China market were actually starting to recover. I think I think Chinese H shares were like up like 6-7% at one time before this drop. So actually markets were starting to recover before this Ukraine and Russian tensions. This is the year-to-date performance lah. Some of the markets are still positive, like LATAM. Okay, I think Malaysia, small cap, Malaysia, China H still positive after the recent drop, and then but overall, overall markets are still negative lah. But if let's say you have a diversified portfolio, probably you won't see like such a big drawdown across. You have probably like an average of this. So I think the point here is that you invest in a diversified portfolio, you won't see that kind of big drawdown compared to if you only had one sector like technology sector or something like that. I think, I don't have another chart here. I don't have it here, but basically it's just to illustrate that. Let's see this chart here. Okay, so this is back to the example that I had, the balanced portfolio with global, Asia, ASEAN, and also Malaysia equities, and also Malaysia bonds. In January, it dropped like 1.7%. So I think sometimes it will drop. Sometimes you can see here over the long run, it doesn't. It's not perfect. Okay, it doesn't stay positive every month. But most importantly, we want to have a long-term positive track record. We have more wins than losses, and the losses you don't see big losses because otherwise, if you lose less, okay, you can recover faster. Like I would say in January, despite the volatility, it only dropped like 1.7%. It's not too bad. Yeah, compared to let's say S&P 500 dropped 7.8%, this kind of thing. So it doesn't prevent you from losing money, but at least it will help to reduce the volatility, reduce the drawdown. Okay, so what industries or sectors in Malaysia or Asia stocks to buy now? Okay. I think in one of the sectors that we really like, it will be financials sector. So if you read some of the articles that we have, we are positive global financials, positive Malaysia financials. And one of the reasons why Malaysia KLCI is positive this year, just now I showed KLCI is positive this year despite some of the other markets like negative territory, is because of the financials also. So in terms of in financials, it's supposed to benefit from a rising rate environment. Okay, and this is because like banks, for example, they make money by taking deposits. They pay the depositors some interest, and then they loan out these deposits, and they earn the spread in between. So-called in a rising rate environment, this margin that they have can be wider, and this will help the profitability. So financials is a sector that we like. Okay, a lot of fund managers are already positioning towards that. So That's one of the sector we like. Another sector that we like will be like some of the reopening ones, like consumer sector, especially those that were beaten down during the COVID pandemic. And a lot of them, their prices have not recovered back to the pre-pandemic levels yet. Okay, so those consumers sector will benefit from the reopening of international borders, interstate travel, this kind of thing, and also consumer spending, because during the pandemic, a lot of people were stuck at home, they cannot spend money. And once it's reopened, then you can see people going out, eating out, go shopping, and etc. Other than that will be technology sector in Asia and Malaysia also, because we think Asian technology, especially like the Chinese one, were quite beaten down last year. Their valuations are very cheap. It's not only cheap, it's very cheap. Okay, multi-year lows. Okay, and we think that the growth potential is still very strong for these Chinese tech. The fundamentals of these Chinese or Asian tech companies are still very strong. Even in 2021, their share price dropped a lot, but they still grow a lot in terms of their revenue. Yeah, so they're capturing more and more of the digital economy. And Malaysia tech, similarly, most of our Malaysia tech companies, they are semiconductor related companies. So they'll benefit from the boom in the demand for all these chips. Okay, as you have probably read, chip demand is still very strong. If you want to, like if you go to Apple store, some of the Apple products you can't even get stock because there's not enough. There's a lot of demand, but there's not enough supply. Similarly, cars also, you want to buy a car, probably need to wait for a couple of months because there's not enough chips to make the cars. And nowadays, a lot of electronics are getting more and more advanced. Then they require more and more chips in them, higher quality chips as well. That's why I think tech sector is another sector that we like, not only in Asia but also in Malaysia. Yeah. Okay. Let's see. Interest rate is expected to rise on fourth quarter this year. How will it affect our local consumer cyclical sector as well as banking? Oh, I think I covered this already. Okay, one of your strategy is a balanced, diversified portfolio like geographical allocation. Wouldn't it be better if we allocate high allocation where there is higher opportunity, for example, higher weightage in Asia? Okay. Yes. So the strategy that I mentioned, this one is just an example. Okay, because I just want to make it simpler for our viewers to understand what I'm trying to do here. In terms of allocation, of course, naturally you adjust it based on, let's say, the more potential one. But here I just make it simple, just like equal weighted, just to illustrate that this diversified portfolio does help reduce overall portfolio volatility, and all this during market, you'll be less worried. Okay, but in terms of the asset allocation, you can just adjust it based on the potential. Like Asian potential is higher, then you just overweight it and you reduce it from something else. This kind of thing. Is corporate bond riskier than government bonds? Yes. So generally, government bonds for each country is deemed as the risk-free rate of that country. So like, for example, Malaysia, government bonds is the risk-free rate of Malaysia. So all the corporate bonds will be priced with using the government bond yields as a base. So let's say the Malaysia 10-year government bond yield is like 3.6%, for example. So the AAA corporate bond in Malaysia ringgit will be higher than 3.6. It cannot be lower than 3.6 because that's the perceived risk-free rate already. So the AAA one will be slightly higher than the 3.6% government bond yields. Then the AA one will be slightly higher than AAA, and so on. So yes, corporate bonds are riskier because people deem it as there's still some credit risk over there. The companies might default, and governments by right, if let's say they issue the bonds in their own currency, they don't have much risk because they can just print more money to repay. Yeah, which is what's happening in the US lah. They just keep printing money. They keep borrowing money and printing money. Yeah. So next, for new investors, would you recommend to focus on S&P 500 as a start, or what is the other ETF to explore? Risk appetite is low to medium. Okay, I think S&P 500 ultimately is still 100% equities. Okay, 100% equities inside the portfolio. So it's still for aggressive investor. If your risk appetite is low to medium, I think you should start with a more conservative portfolio, like I mentioned here. Let's say you say your risk appetite is low to medium, so maybe you can start with like 70% fixed income, 30% equities. So the 30% will be something like a mixture of US equities, European equities, Asian equities, Malaysia equities. Then the rest will be in the more stable income producing assets like fixed income. Yeah, if you're a low to medium investor, risk appetite investor. So S&P 500 is still 100% equities. The volatility is, yeah, equity market lah. It can drop like 8% in one day, like what happened in COVID-19. So I'm just giving you the worst case scenario so that you know that, oh, is it within my risk appetite or risk tolerance? If it's not, then you balance it out. You add in some fixed income just to make the overall portfolio volatility more manageable. Okay, so US Fed interest rate hike affects funds and shares. What can we do as investors? Okay, so let's see. I have a slide. So the first thing to start is, why would the US Fed hike interest rates? Because the economy is doing well, only they will hike interest rate, right? If the economy is not doing well, they'll not hike interest rate or they'll cut interest rate to boost the economy. So firstly, the US economy is doing well, and if it is doing too well, the inflation has overheated. So in terms of long term, if you look at some of the articles that we've written, is that the interest rate hikes, markets still can perform well in an interest rate hike environment, okay, because they're supported by the fundamentals of the companies. The economy is doing well, okay, the companies earn more money, there's a lot of jobs for everyone, people spend money, then the companies earn more profit. So the earnings of the companies are growing. Ultimately, it will neutralize the impact from this interest rate hikes, as we have seen in the past. I don't have the charts here, okay, but we do have the research that look back on past interest rate hikes, and markets still continue to go up after that. It's backed by fundamentals lah. And ultimately, the only reason why the Fed would raise interest rate right now is because the economy is doing well. Yeah. So going forward, okay, we still like equities, okay, over bonds, okay, but that doesn't mean like don't invest in bonds at all. There's still pockets of opportunity in bonds, okay. Equities, the first point, we still like equities. So overweight equities over bonds in your portfolio. Of course, you must look at your risk profile and risk appetite to see how much equity risk you can take lah. Then the bond part, okay, try to balance it out with some Malaysia bonds. If you are more conservative, then you go for short duration Malaysia bonds. If you're a bit more aggressive, which I think is okay, to be honest, you can go from low to medium duration Malaysia bonds, which has done quite okay since October. And next, what else can we do in terms of sector positioning? Position in those sectors that will benefit from interest rate hikes, like financials. But a lot of the fund managers are already doing that. If you look at some of the Malaysia funds, for example, they're already increasing holdings into banks. And what else? What else can we do as investors? In a rising rate environment, also it doesn't mean that growth stocks will underperform as well. So similarly, we have also done some research, okay, based on past interest rate hikes, because some of our questions that came in were like, will tech companies underperform in a rising rate environment? The answer is actually no. If we look at historical, it's not the first time we raise interest rates, right? So ultimately, the tech companies, they continue to grow, okay, grow their revenue, grow their profits, and it will just neutralize whatever interest rate hikes that's gonna happen. So I think, yeah, definitely overweight equities over bonds, lower the bond portfolio duration. Then Malaysia bonds, I think there's value over there. Then sectors that will benefit from interest rate hikes like financials, and also growth companies will also do well, especially their growth is higher than whatever interest rate or inflation that's happening. So it will outstrip or outperform all this inflation or all these interest rate hikes, as we have seen in the past. And you can see here, thematic opportunities, digital economy, which is basically tech, okay, US digital economy. The drawdown actually gives opportunity to lock in a lot of these good companies at, cheaper than the peak prices. Financials, position to benefit. Asian high yield this one is probably a bit more for aggressive investors, okay, but there's definitely value over there. Just you need to take on the credit risk, but I think it's okay for aggressive investors at the moment, because a lot of Asian high yield bond funds are giving 10+% kind of yields. Of course, there's credit risk that's coming from what's happening in China property sector, okay, but a lot of them have been sold now. That's why you have this 10+% yield. And I think it looks attractive to me as well. So in a rising rate environment, because all these Asian high yield bonds have been sold down a lot, okay, they've been sold down a lot, the prices are trading well below par, okay, and there's a big spread between Asian high yield and also US treasuries, so the interest rate hikes will have less impact on Asian high yield, theoretically. And which unit trusts are recommended for 2022 themes? This one, we do have an article, the 2022 key investment themes and outlook. You can check it out, and the recommended funds for each theme that we have.
Yes, we have a recommended list that they can refer it. Yeah.
Yes.
Yeah. Yes. Okay. I think Jason, you addressed most of the question of our participant, and I think it's a time to end our presentation already. And thanks a lot for your presentation and also helping to address our participant doubts. And I believe this topic is very interesting because mostly they will worry about what to do next. And your 5 points basically on the risk profiling, diversification, and dollar cost averaging. This is something that normally we hear from everywhere, but sometimes we never really focus on it. So probably at this time frame, based on Jason sharing just now, I hope all of us are able to look back again our risk profile, diversification method that we used, and you restructure your asset allocations. Okay, so all the participants, let's say if you guys have more questions, feel free to drop an email to our investhelp@fundsupermart.com. So from there, our CIS team will address you all the questions, or maybe you need a portfolio review, or you need a portfolio suggestions as well. You can drop an email to us. Okay, so there will be several upcoming webinars with the different topics. So you may always visit our FSMOne website to see our events details, and you can register online. Okay, so again, ladies and gentlemen, we hope this session has added value tools to your investment decision and to your investment journey. Thanks again to Jason for your wonderful sharing, and thanks to everyone for joining this evening. Thank you very much. Have a good day.